Hello everybody, I hope you're doing great. So today let's discuss some terms from financial management and accounting. First one is asset. What is an asset? So it is a resource that has the potential of bringing you some economic benefit, maybe today or in future. For example, if you own a house, you can sell it in future and it will provide you some economic benefit in future. You can earn from it in future, or maybe today you are earning out of it. So that is an example of an asset is something that promises, that has the potential of bringing you some economic benefit. However, liability is the burden that you hold. It is something that you are obliged to make economic benefit to some other entity. So you will have to make some future sacrifice in future. You will have to pay something to someone in the future. So that is liability, that you are obliged, that you have the responsibility, that you will have to pay someone in future. So that is a liability you're having. There's a economic burden on you. That is liability. So that is the difference between two. Asset is the something that is providing you economic benefit in future, and liability is that you will provide economic benefit to some other entity in future. What is capital and capital structure? Capital is the money you invest for running a business or starting a business. Maybe you've invested in some machinery or in a vehicle for stocks, into bonds for a software, or getting some patent. So you need money. That money is called capital. The money, the sum of money, the funds you invest for starting your business or for running your business. And capital structure is, what is the nature of this capital? What is the nature of this finance that you have raised? Have you raised it from debt financing or from equity financing? Is it through equity capital, equity shareholders, or from preference shareholders? You've collected the funds for running the business operations, for starting the business, for buying the assets. So you will need money for running the business. And that structure of the capital, is it from long term source or short term source, long term loans, short term loans, equity, preference. So all that, the mix of debt and equity, the structure of the capital is called capital structure. Then comes AR and AP, accounts receivable and accounts payable, where account payable are the obligations for item purchased from the supplier. You can purchase goods, purchase material from supplier on cash or on credit. Now when you are buying something on credit, you are obliged to pay the person in future. So this person will be called the creditor, because you have purchased something from him or her on credit. So you will pay him something in future, and this amount will be called account payable, because you are obliged, you will have to pay the person in the future because you have purchased items from the person on credit. So that is accounts payable. And account receivable is exactly opposite, that you will receive something from someone because you may be receiving from customers or from partners. So the people, those people from them you will be receiving, are obliged to pay you something because you have sold something on credit. So they will be called debtors, and you will receive something from debtors, that is called account receivable. Because we have two systems of accounting, accrual system and cash system. So accrual is when the transaction has been made. If there's a transaction, you will record it then and there, no matter when you are receiving the cash. That means that you are recording the transaction because the people involved in that transaction are obliged to pay or receive the items, pay the money and receive the money. So maybe they will be getting the money in future, into cash in physical in future, but there's a promise that they will be paid. So that is the difference, account receivable and account payable. As the name suggests, receivable is when you will be receiving, and payable is when you will pay to the creditors. Then comes bonds and debentures. These are the instruments of raising finance. You can raise finance through bonds and debentures. Now, bond is an instrument that is issued for raising an additional amount of capital. These are mostly issued by the governments and corporations. Government agencies are there, and private, maybe private as well. But In this case, you will have to present some security, any collateral, any physical asset as a security for raising money through bonds. However, in case of debentures, these are mostly issued by the private agencies and you don't need to present any security, any physical asset or collateral. But they are backed up by your credit worthiness and your reputation. They will look into your financial position and your credit worthiness and reputation. So that is the difference between two, that in case of debenture you may not need to present uh, any physical asset or collateral as a security. However, in case of bonds you need to present some collateral or security. Then comes equity and dividend. Shareholders' equity is simply the money shareholders have invested in your company, in your business. So this is the amount the owners, the shareholders of a company have invested into the business. And dividend is the reward or the cash you pay back to the shareholder. So you raise finance through shares and these shareholders are paid a share of profit, maybe percentage or a minimum cap. So that is called dividend. What you pay to your shareholder is called dividend, and this is as per the company policy, that how much they want to pay to their shareholders, how much amount they want to pay as the dividend to the shareholders, and they have this choice that they pay or they not. That is the difference between equity and shareholders. Now comes surplus. It is simply the excess, something that you don't require. For example, profit, capital, goods, something which is not used, that is surplus, which is not being used. Any excess of something. And when this excess of income, there's an income, there's money you have earned, and that is you are not using it in for dividend, for paying the dividend or for taxes. So that surplus earnings is called retained earnings. From the earning, you will have to pay to the shareholders, but what is left is called retained earning. So surplus of income, surplus of earnings is called retained earnings, and surplus is any excess amount. Depreciation. Depreciation is simply the monetary value of an asset that has decreased over time due to wear and tear, due to its obsolescence, that is, it has become obsolete. The technology you were using has become obsolete. So there's the value associated with every asset, and after a period of time, due to wear and tear, due to uses you have used that asset, its value will decrease, and this decrease in terms of monetary, representing this in terms of monetary value, is called depreciation. Amortization, it is simply when you spread the schedule for the loans. Banks have this schedule for the loans interest payment, that is called amortization. But amortization of intangible assets in terms of accounting, it's simply intangible assets are asset is something that will provide you benefits in future, economic benefits in future, and intangible, that is not, you cannot touch them, they are not, there's no physical evidences of them. So these are goodwills, your patents, your copyrights or trademarks, these are your intangible assets, and their amortization is simply the spreading the cost of getting the goodwill, getting the patent, getting the copyrights, trademarks, these intangible assets, the cost which was involved for getting these assets, intangible assets, you will spread this cost for a certain period of time, for the time it is valid for. For example, you have got the patent for 10 years and the cost involved was 10,000. So you will spread this 10,000 into 10 years. So that is called amortization of the intangible assets. So that's the end of video. I hope you like it. I hope you learn something new. Thank you. Have a great day.